Hello and welcome to my channel. My name is Aarinola. Today I will be talking about banking and financial markets. This video will be focusing on some fundamentals that you should know about banks and also about investing in bond and stock markets. Financial intermediaries like banks and financial markets both exist as a channel to raise capital and to match those who want capital with those who have capital. Using commercial banks as an example of a financial intermediary that is raising capital and matching those who want capital with those who have capital. Individuals and businesses who have money to save can save money by depositing it into a commercial bank. By doing this, they become a lender to the bank and will receive some interest payment for depositing. The bank bundles up all the deposits that it receives in various ways so that it can be lent to those who want to borrow. And when individuals and business customers borrow by taking out loans from the bank, they will be charged an interest rate for borrowing. The amount of interest that the banks collect on the loans that they have given out to customers is always greater than the amount of interest that they pay customers with savings account, and this difference is the bank's profit. It is typically a good thing to keep money in a savings account because it is a safe place to store your money and it provides an easy way to make withdrawals. However, it will earn you very little interest. Whereas investing is different from saving, as investing will involve buying assets with the expectation that your investment will make money for you. One of the ways to invest your money is to buy assets in the financial markets. Financial intermediaries, for example, investment banks, invest and trade in financial markets on behalf of individual investors, corporations, and governments by taking money from those who want to invest and then deciding where and how to invest the money. Because of the regulations that control bank activities, commercial banks will make most of their profit from the difference between the interest they've charged customers for taking out loans and the interest that they paid those with a savings account rather than actually investing in financial markets. These regulations don't stop commercial banks from participating in financial markets, but they do limit how much and the way in which they can actually participate in financial markets to ensure that they don't risk and lose too much money in the markets, as this could hurt their ability to repay the depositors and to remain in business. Bonds and stocks are types of financial assets. Each type of financial assets are traded in their own specific financial markets. For example, bonds are traded in bond markets and stocks are traded in stock markets. Short-term bonds are bonds with a payback date of within a year and are traded in the money markets, whereas long-term bonds are bonds with a payback date between 1 to 30 years and they are traded in the capital markets. Government bonds are a good example of short-term bonds. Corporations can also issue out short-term bonds. What basically happens in the money market is that governments and corporations who are looking to borrow capital will issue out short-term bonds to investors with the promise to pay back the investors within a year. Whether you invest in short-term bonds that are in the money market or in long-term bonds that are in the capital market, investing in bond markets is generally a secure thing to do because it is mandatory for bond issuers to pay back the money and investors will also be getting regular interest from bonds that they hold. Even when corporations go bankrupt and have to be liquidated as part of the bankruptcy proceedings, when limited liability kicks in, bond issuers are mandated to prioritize paying back bond holders first. Other things to consider when investing in bonds is whether the bond is a junk bond or an investment grade bond. Junk bonds will generally offer a higher interest payment to investors because they have been issued out by companies with below investment grade credit. These are companies that have been rated BB or lower by rating agencies like Standard & Poor's and Moody's, which reflects that it is likely that the bond issuer will default on the bond. Stock market is a particular category of capital markets, and it is a place where equity securities are traded. It is generally believed that people who are saving for retirement may want to invest in capital markets like the stock market because they are more concerned about accumulating wealth rather than preserving wealth and do not have the need to get the money back in a short period of time. Unlike bonds, which can be traded in both the money markets and capital markets, depending on whether they are short-term debt instruments or long-term debt instruments, stocks can only be invested in or traded in the capital markets. Like bonds, one way for corporations to raise capital is to issue out stocks to the public. When you buy shares in a company, you are taking ownership of a company, so you will have a stake in the company profits as the company grows. You will get your returns from capital gains and from dividends if it is a dividend paying stock. A capital gain occurs when you sell a stock at a higher price than the price at which you purchased it. And a dividend is the share of the profits that a company distributes to its shareholders. Some things to consider if you decide to invest in the stock market is that, unlike bonds, the money that you initially invested to buy the share is not paid back to you, as it is not a loan. You are simply taking some ownership of the company. Also, because shares are typically issued by small companies, startups, or companies that are finding it difficult to raise capital from institutional investors, perhaps because these companies may lack a financial track record, because they're startups or they're small companies. This makes stocks a high risk investment, as there's a risk of not getting your dividends if it is a dividend paying stocks, and you may not get your original investment as it is not covered. However, stocks will generally get you a higher return than bonds. Both bond markets and stock markets are grouped into primary and secondary markets. When bonds are originally issued to investors, this is known as the primary bond market. The other way that bonds are sold is in the secondary bond market. The majority of transactions in the bond market take place in the secondary market. The secondary market represents when an investor that owns a bond sells it to another investor. Institutional investors will purchase bonds through the primary market and then turn around and sell them to other investors in the secondary market. The biggest differences between the primary bond market and the secondary bond market is the purchase amount and the level of skill required to trade in them. In the primary market, investors are only going to pay the face value of the bond. For example, if the bond has a face value of £2,000, the investor is only going to pay £2,000 for it. Whereas in the secondary bond market, bonds will rarely sell for their face value, and the value of the bonds will be drastically impacted by interest rates in the market. If interest rates in the market are higher than what the interest rate of the bond is, the value of the bond is going to decrease. And if interest rates in the market are lower than what the interest rate of the bond is, the value of the bond will increase. Investing in secondary bond markets require more skill and practice to accurately value the bonds that you are buying and selling. Similarly, when stocks are originally issued out to the public, this is known as the primary stock market. Some of the most publicized primary stock market transactions are initial public offerings, IPOs. During an IPO, a primary market transaction occurs between the purchasing investor and the investment bank that is underwriting the IPO, and any proceeds from the sale of shares of stock on the primary market will go to the company that issued the stock after accounting for the bank's administrative fees. In primary stock markets, the price of stocks are set beforehand. To invest in the primary stock market, it is important to carry out some research and fundamental analysis to make sure that the stock price is a correct reflection of the true intrinsic value of the underlying business. This will involve using valuation metrics and other information, including looking for companies with a strong balance sheet and consistent earnings to ensure that short-term fluctuations won't affect the long-term value of the company. Whereas the secondary stock market is what most people typically think of as the stock market. In the secondary stock market, investors exchange stock that they own with each other rather than with the issuing entity, and the proceeds of each sale will go to the selling investor and not to the company that originally issued the stock, and also not to the underwriting bank. Prices in the secondary stock market are not set beforehand, but are determined by the basic forces of supply and demand. So if the majority of investors believe that a stock will increase in value and rush to buy the stock price will typically rise. But if a company loses favor with investors or fails to post sufficient earnings, the stock price will decline as demand for that security falls. Technical analysis is crucial to trading in the stock market. Technical analysis generally assumes that a stock's price reflects all the available information and that stock price will generally move according to trends. Therefore, it will involve analyzing a stock price history and trying to identify patterns in stock charts to predict the future stock price behavior. I've come to the end of this video. I hope you've enjoyed watching and learned something from it. If you have any questions about anything that was discussed or would like to contribute, please comment below. Also, please like and subscribe to my channel. Thank you so much for watching. I really appreciate your support and wish you all the best in your learning. Bye.